Forex can look overwhelming. Candles, charts, spreads, pips, it feels like another language. But here's the truth, in less than 20 minutes, you'll not only understand the basics clearly, but you'll also know how to avoid the mistakes that wipe out most beginners. And here's the bonus, stick with me until the end, because I'll reveal the number one mistake new traders make with leverage, and how you can protect yourself from blowing your account. Welcome to BigPips Trading Solutions, where we cut through the noise and give you simple, practical strategies to trade Forex the smart way. This is episode 1 in our step-by-step Forex tutorial series. Each video is designed to take you from beginner to confident trader, one lesson at a time. So, if you're serious about learning Forex, hit that subscribe button and turn on the bell. You won't want to miss episode 2, Mastering Risk Management. What is Forex? Let's start with the basics. The foreign exchange market, commonly referred to as Forex, is where currencies are bought and sold. It's the world's largest financial market, with over $6 trillion traded every single day. Think of it like this: when you travel abroad, you exchange your dollars for euros or yen. That's Forex. Traders just do it on a much larger scale, and for profit. Currencies are always traded in pairs, like EUR/USD or GBP/JPY. If you buy EUR/USD, you're betting that the euro will rise against the US dollar. If you sell, you're betting it will fall. Now, let's talk about pips. A pip is the smallest unit of movement. For most pairs, it's the fourth decimal place. Example, euro to US dollar moving from 1.1000 to 1.1010 is a 10 pip move. Pushpin quick quiz: if GBP/USD moves from 1.2500 to 1.2530, how many pips is that? Pause for 3 seconds, that's right, 30 pips. This is how we measure profit and loss. How the Forex market works. Forex is unique because it's open 24 hours a day, 5 days a week. That's because it follows global financial centers. Asian session, Tokyo, Sydney. London session, biggest liquidity. New York session, pairs well with London overlap. Most action happens when London and New York overlap, that's when liquidity is highest and the big moves happen. Unlike stocks, Forex has no central exchange. It's decentralized, meaning trades happen through a network of banks, brokers, and traders worldwide. Now, let's talk leverage. This is what excites people but also destroys accounts. If you have $1,000 and use 1-to-100 leverage, you can control a $100,000 trade. Sounds powerful, but if the trade goes against you, your $1,000 can disappear in minutes. Write this down: leverage is a tool, not a shortcut. Used wrong, it's the fastest way to fail in Forex. Why most beginners fail? So why do most beginners fail? 2 main reasons. 1. Overleverage, risking too much on one trade. 2. No plan, trading random setups like a lottery ticket. Here's the truth: the market rewards consistency, not luck. Let me give you a quick example. Imagine 2 traders. Trader A risks 50% of their account on one trade and loses. Account gone. Trader B risks 2% per trade. They can take 10 losses in a row and still have 80% of their account. Who do you think survives long enough to learn? Trader B, every time. The smart beginner's approach. So what's the smart way to start trading Forex? Here's my step-by-step beginner roadmap. 1. Learn the basics, like you're doing now. Don't jump into trading blindly. 2. Open a demo account, practice without risking real money. 3. Focus on 1 to 2 pairs, study their behavior. EUR/USD is great for beginners. 4. Always use stop losses, this protects your capital. 5. Journal your trades, so you can see what's working and what's not. Pro tip: treat demo trading like it's real money. Build habits that will protect you when you go live. Let's quickly recap. Forex is the largest financial market in the world. Currencies are traded in pairs, measured in pips. Market sessions overlap for the best opportunities. Most beginners fail because of overleverage and no plan. And the smart way to start is with education, demo practice, and strict risk control. If you got value from this breakdown, smash that like button and subscribe for more tutorials. And don't miss episode 2, Mastering Risk Management, because managing risk is what separates